Well, good morning, everybody. Happy Wednesday to you guys. You guys ever have technology issues? Anybody else ever have technology issues? I swear. I laugh about this is like printers. They are like, what is the deal with printers? Like out of all technology, and technology has been around for a long time. Printers just cause me a headache. I've been trying to print something off all morning, and it took like 5 minutes to print one document. I just don't understand why those things never work. Anyway, I just find it hilarious. All the technology we have and printers just seem to struggle still. Oh gosh. Anyway, welcome to the live stream. This is not what this is about. It's not a technology channel, but man, I want to kill it. So anyway, thanks for coming in. Thanks for joining me this morning for the daily brief. This is your first time here. Welcome. So welcome to the Real Estate Advantage. This is a daily brief that I do every single morning, Monday through Thursday, 8:30 a.m. Eastern time. I basically talk about real estate in the news and what's going on, and read through some articles, give some of my practical advice, kind of help you guys cut through the noise as real estate agents and kind of get to the root of the truth of what you might find inside of these articles. And so that's what we do here. So welcome, settle in. We'll get started today just as a kind of to tell you what's coming soon and what's upcoming in this episode this morning is I've actually got a few articles. We're going to kind of do a few different categories as we go through this morning. So what I encourage you to do is, engage with me in the comments. Throw out some comments, throw out some questions, and maybe even if you have some advice and you have some experience in some of these articles that I'm reading through, and whatever you want to share. I love that. I will bring it up on stream. We'll talk about it. I will pause what I'm talking about, and we'll just have a good discussion. So feel free to do so. I enjoy that kind of communication. So don't hold back. Now, today, what we're going to be going through, I'm going to begin kind of talking about two signals that push mortgage rates higher. Just because we've had a little bit of an influx of interest rate, not mortgage rate, not anything drastic, but just it's upticked just a little bit. So I'm going to help you read an article that gives some context to what that actually looks like and how we kind of scale up from there. Or I'm sorry, why interest rates might fluctuate depending on certain conditions in the market. So that's what we're going on there. I need to drink more coffee. Then I'm going to do a article from the National Association of Realtors that's talking about the home sales perk up as housing affordability improves. So we'll talk about housing affordability and what that actually looks like as we go forward. Got another article talking about should buyers tap retirement savings like their 401ks to get access to funds to use for down payment. I'm going to read through an article talking about that, balancing that, kind of the thoughts behind why someone might do that or really the risks on why you maybe shouldn't do that. So there's a little bit of this, and this is happening because of that affordability gap. So that's why I'm kind of staggering these articles in that way. I'm trying to help everyone kind of understand that maybe this is not a good idea, but maybe it might make sense in some cases. And we'll get into that. Then the last two articles I'm going to talk about is one is, and this is by Inman. It's titled "The Internet Says Agents Are Doomed Again." Here's what's actually happening. And the subheading says social media says real estate agents are finished. The reality is more nuanced. And these are those typical headlines that just kind of circle around every once in a while. We're going to read through it. We're just going to kind of dissect it a little bit, find out what they're talking about, and put it into context. And then the final one that I'm going to read, and this is going back into the conversation that we've kind of had, I think, on every single live stream this week. And it's because of the Compass, Redfin, War, and Zillow, and all this kind of stuff. We're talking about private listings. And like yesterday's live stream, I talked about that whole entire process and what Compass was aiming to do and the fiduciary responsibility that agents owe to the seller. And there's just a big discussion going on right now about all these things. And I want to have that discussion here as well. I think it's important that we do so. I think that we don't, I wouldn't just, hone in and listen to all this noise and then just focus on it every single day. But this type of conversation does lead to some disruption in the industry. And if that's the case, we need to be paying a little bit of attention to what's going on and adapt as we go forward. And in this article, this is again an opinion piece on Inman, and it's titled "Ready to Kill Your Brand and Your Lead Gen." It was a question: ready to kill your brand and your lead gen? Take private listings. So this is an opinion piece talking about that. So we're going to get into that. We'll talk about kind of what that is. I'll give you some of my observations and kind of dissect this a little bit more. But what I will encourage you to do is go to my YouTube channel, The Real Estate Advantage. You'll see my picture and all that. Go to there and watch yesterday's live stream. And I've got, probably by this afternoon, I'll have the chapter tags on there. So you'll be able to jump to certain stories. Go to that YouTube channel and watch that live stream from yesterday talking about the Compass Redfin deal and how that correlates and what Compass is trying to do. Then you can come back and watch this again. You'll kind of see the two opposing views a little bit. So I just encourage you to do that if you want to kind of go a little deeper in this conversation we're having about private listings. So that's what that is going to be about. So hopefully that will help you. So with all that being said, that's what's coming up in this show. Let me go ahead and get just one more website up because I've been doing this every single time and I keep forgetting to pull it up, but I want to begin with this as a topic. Whoops, not mortgage calculator. Mortgage News Daily. So we'll begin there once I get the show started. Yeah, there we go. Okay, here we go. I've got everything situated, drinking coffee, and we'll get started. Welcome to the Real Estate Brief. I'm Adam, and today we're cutting through the noise. We're going to get to the truth that we can find inside of the news. We're going to look at all the data. I'm going to give you some of my observations and where I believe that you can find some opportunity in regards to all the headlines. So if you're ready to gain your real estate edge, let's dive into our very first story. And to begin our first story, I'm going to go and use what I've been using pretty much every single day that I do a live stream. And we're going to start with just doing a quick little snapshot about what the mortgage rate currently is. And I'm doing this right now because it's always talked about in the media. Everybody's always talking about the interest rate going one way or the other, and it spurs all kinds of headlines and that kind of stuff. So if I begin this conversation today, going into the next article, I think this will help us to kind of understand what's going on a little bit better. So let me jump over into Mortgage News Daily. Now, if you're on TikTok, I would encourage you to download the app Mortgage News Daily. You could open that app right now and you could see what is going on as far as interest rate goes. It also has a mortgage calculator, that kind of stuff on it. It's just an easy, simple way to kind of pull some information. I say this every time. I'm not an affiliate of them or anything like that. It's just a resource that I use on the daily. I open it up every single day. I see what's going on with the interest rates, and I might even read some news articles that they might post on their site in regards to the mortgage industry. So if I was to quickly just read the headlines on Mortgage News Daily, it would say mortgage rates sideways to slightly lower. Then it says afternoon weakness in bonds despite lower oil prices. Will CPA matter? So these are all headlines that talk about the mortgage industry. So if you want to kind of go and dip your toe a little bit as a realtor into the mortgage industry and get some news from that side of things, it's a great app to do so. So that's what that is about. Now, if we scroll on down, we'll see what's going on with the interest rate. And this is just an interesting little side bunny trail here for just a second. I might sneeze. Hold on. Maybe not. Trees are blooming. So here's where we're sitting at currently. Now, yesterday I pulled this Mortgage News Daily app up yesterday, and we looked at what the mortgage rate was, and it was 6.14. 6.14 is what the interest rate was yesterday. I'm going to go ahead and just open this up for those on TikTok just so you can kind of see this. Right now, let me get my camera switched. Right now, we're sitting at 6.09% for a 30-year fix and 5.69. So the market improved just a little bit yesterday. I mean, marginally, right? And we're talking, is it 0.14? Now we're at 0.09. So it's just nothing really that drastic, but it's still a little bit of a fluctuation. And it can be so confusing if you watch these type of things every single day, because like what causes kind of number to fluctuate and that kind of stuff. And it's good for us to kind of go down that road and understand what causes a mortgage rate to fluctuate like this. These are marginal shifts, nothing too drastic. We talk about this all the time that I feel like it's going to hover right around, the 6.2 to maybe might dip below 6 here and there. We're going to try to probably more than likely the feds and everybody else is going to try to hold the rate close to that number. And we're going to get into that conversation right now. So just bear with me. So right now, that's kind of what we're looking at. We're looking at a 6.09 for 30 year. We're looking at 5.69, 15 year. And then if you get into the more creative financing categories like the ARMs, you can get down to 5.39. Then FHA and VA is hovering right around 5.7. So if you qualify for those type of loans, it's a really good loan, guys. It's a really good loan if you can get them. Especially VA. VA kind of got a bad rep a few years ago, but they're doing an amazing job right now. It's a good loan for those that qualify. All right. The very first article we're going to talk about. Sorry for the little tease there with the sharing the screen, but So this article is going to come from Florida Realtors Association, and I've actually pulled, and I say this all the time, I pull a lot of articles up from there. It just kind of seems to hit inside of my news aggregate app that I use, because they post a lot of good stuff, and so it kind of comes to the surface a little bit. But this article in particular is being by Taylor Gettler. It says 2 signals push mortgage rates higher. So what we're noticing is that these rates are ticking up again. There's a slight uptick. Like we go a couple weeks ago, we were at like 5.99 or something, right? We dipped below 6. What's really happening is, and if you look at the headlines, you read about oil prices and fluctuation of job employment and, affordability gaps and all these type of things. All these little micro factors go into that mortgage rate and that being adjusted. Now, what we don't want to confuse is when we start talking about the Fed rate, which is typically, across the board economically, right? If you're going to borrow money and this is the rate that drives the economy, that's not the mortgage rate. Now, the Fed adjusting the actual Fed rate does have an effect on the mortgage rate, but it doesn't always coincide. Other factors are at play here. So what we're looking at in this market, what's really causing some of these adjustments is kind of about inflation and the persistence of that in regards to the labor strength that we find as far as unemployment and the amount of jobs being added. So we need to look past a little bit of what we see in the numbers and get into what this actually means in regards to your clients and now being a good time or not a good time to buy. That's where we're at. So let's go ahead and start talking about this article. And I won't labor on this too long. We're gonna burn through this one probably pretty quick. It says 2 signals push mortgage rates higher. It says mortgage rates rose this week as Middle East tensions pushed oil prices higher, while a weaker jobs report added new uncertainty to the economic outlook. So you've got an external economic factor. You got a looming bombing and things going on in Iran, and you got oil prices going higher, which causes a shift in the affordability, right? The amount of money I've got to now pay for gas and other services has gone up, caused that affordability gap to change and cause some uncertainty, right? All right. It says in the week ending March 6th, the average 30-year fixed mortgage rate went up 7 basis points from the week prior to 5.94, according to rates provided by NerdWallet by Zillow. A basis point is 1/100th of a percentage point. Okay, so that's that adjustment. APRs for 30-year fixed mortgages averaged 5.92 in February, down 7 basis points from January's average and down 84 basis points from February 2025. So let's just pause for 1 second. And when we start talking, we got to remember where we were last year. So if you're a realtor out there and you're listening, think about the year that you had last year. Those rates hovered right around 7%. They went back and forth around the 7% range. So when we start looking at these numbers, we see this slight adjustment. Remember, we are in the low 6s. We are almost an entire percentage point lower than the market was last year. So when you start reading headlines about rates going back up, look, we are still historically low, the historical low we haven't seen in 4 years. So the reality is this is setting us up for a good 2026. It's still a much lower percentage point. So if you go back and you compare what happened last year in the market compared to what could possibly happen in this market, it's looking pretty good. Nothing drastic though. It's more of a stagnation, more of a balancing and a restructuring of the market, but regardless, it's not a crash. Now, let's go on here. It says how conflict in Iran affects mortgage rates. It says as the 4th largest oil producer in OPEC, which is the Organization of the Petroleum Exporting Countries, Iran's instability means oil price instability. The Dow Jones Industrial Average fell nearly 800 points on Thursday as U.S. oil prices surged. According to the Wall Street Journal, rising oil costs have stoked investors' concerns about inflation. Okay, so that's the concern, is when you start having these type of things take place, then you have a supply and demand issue and things can tilt in one direction or the other. So they're watching that. Remember that the market and the economy, as much as we want to say it's based on pure facts and pure data, it's really not. It's based on the emotions of the investors involved or the emotions of the consumer. That's what's going to dictate a market more than anything. So we got to keep that in mind as we read this. It says the farther that inflation moves above the Federal Reserve's 2% target rate, so we talk about this all the time, the Federal Reserve wants an inflation across all industries, okay? If we're talking about any kind of increase in inflation, in pricing or whatever, to be right around that 2% month over month or even year over year, okay? That's what they're looking for. The target rate is 2%. If that number keeps going up higher and higher above the 2%, then they begin to change the interest rate, and they usually scale the interest rate up to slow the inflation, to make it a little bit more cost heavy to buy, slowing down the inventory. And that's across all industries. We're not talking about just real estate, but it's still a number they watch on the housing market as well. The less likely central bankers are to lower overnight borrowing rates. This has an indirect effect on mortgage rates. When the federal funds rate is lowered, it's cheaper for banks to borrow from one another to fund mortgages, and those savings can be passed along to borrowers. All right, so that's the supply and demand issue. That's what happens here. That's the way that number works. For those members of the Federal Open Market Committee who are more concerned with inflation, this could position them in direct conflict with the president's nominee for the next Fed chair, Kevin Warsh. President Trump has made it clear that he expects Warsh to align with his goal of slashing rates, even joking during a speech at Washington dinner in January that he'd sue if Warsh didn't get it done. So there's a little bit of political pandering there, agree or disagree with Trump. That's not really the point. But the point is, he's got a mission to cut rates. At the same time, the feds and everybody else have a mission as well, and that's to curb inflation. So the reality is you can have rhetoric from Washington and you can have comments like that. You can have a drive to do that kind of stuff and a focus on that, which causes them to make decisions and regulations that maybe help the housing industry, which you saw that being taken care of in the housing bill that was passed. At the same time, what the Fed is going to be watching is that inflation rate. They're trying to keep that low. They're trying to keep that around the 2%. That's a stable market. This is the next point. It says the U.S. lost jobs in February. The Bureau of Labor Statistics released the February jobs report this morning, revealing weaker than expected employment numbers. While it was projected that the U.S. would have added 50,000 jobs, the report showed a net loss of 92,000. The unemployment rate remained flat at 4.4%. Okay, so that's the interesting thing. Like the unemployment rate didn't really change much, but then the growth of jobs didn't. It didn't grow. So this is the tension right there, right? So it says the job losses aren't exactly as dramatic as they sound. They can be mostly attributed to slowed hiring in healthcare, which the BLS links to strike activity. Employment growth has been largely concentrated in this sector, so this change is bringing down employment numbers as a whole. While slow growth doesn't beget a very strong economy, it's not always cause for panic. However, this jobs report changes the calculus for the Fed meeting in a few weeks. The labor market remains an uncertain footing. As of Friday afternoon, analysts are still largely predicting that central bankers will keep rates steady at their meeting later this month. So you've got two opposing factors that are causing the interest rate to kind of go up just a little bit. The rising of cost of goods across the country, and then you've got a labor market that's not showing a drastic change in unemployment, but you're not seeing new jobs being added to the market. So there's a little bit of concern here that they are watching these numbers. The key here, though, is why it's not changing that much is because there's just micro changes even inside of these statistics. So we see micro changes in the interest rate. We see micro changes in the economy. So that's the correlation. So nothing drastic. Again, even though you see these numbers fluctuating all the time, they're marginal at best. They're marginal at best. So what, the reality is what I would just, in regards to like news like this, I would go and talk to your buyers and your seller, more specifically your buyers, walk them through. If they're reading articles or they make comments about the interest rate going up and that kind of stuff, and they're more negative about it, I would get a mortgage calculator out, show them the differences, show them what the cost is, what it was when it was quoted, 2 weeks ago at 5.99 versus what it is now at 6.14. We're not talking about a huge drastic change in the purchasing power, right? That's not what we're seeing. We're seeing a change, but nothing drastic. Now, if somebody is, was on the fence like in 24 when it was like, or 25 when it was like a 7% interest rate, this is the time to call them up. I mean, this is when they're going to actually save a lot of money compared to what they were looking at back then. So I'd be talking to them. So anyway, there's kind of an update there. That's about it as far as the, mortgage rate. I just wanted to kind of quickly discuss that because we hear on the news, and I just saw an article this morning, interest rates are spiking again. It's like, man, come on. Like spike, like what do you mean spike? I mean, if you compare last year to this year, it's almost a whole entire percentage point lower. There's no spike going on. It's fluctuating. It's fluctuating at best. Okay. Now, let's get into what NAR, the National Association of Realtors, is reporting. And what they're going to report in this article here is more of a perk up in sales. And what they're going to be talking about is affordability. And it's finding kind of a temporary, I say temporary, maybe more of a stagnant sweet spot in some ways. And we'll get into that. So this headline is to be honest, mostly optimistic. And the whole article is pretty optimistic using data. So this is where we're going to lean in pretty heavy because I like data. Data tells us a story. And that story we can rely upon because it's tied to, objective data. So we can use that as information. But now just keep this in mind as we go through this. This is nationally. This is not local. So anything we talk about here, you got to take it to the local level and see how that correlates. Okay. So just keep that in mind as we go through this. All right, so this is by the National Association of Realtors. March 10th is when this was written by Melissa Dittman Tracy. The title is Home Sales Perk Up as Housing Affordability Improves. So let's go ahead and read this article together. Existing home sales rose slightly last month as lower mortgage rates and slower price increases help better position buyers this spring. So a couple of things to note in there. We already talked about that. The lower interest rate is going to spur activity. Slower price increases. So again, going back to that inflation conversation, in most markets, again, nationally speaking, in most markets, we're looking at around a 2.4 to 2.8% month over month inflation percentage. So we're close to that 2%. So there's not a drastic price increase. Matter of fact, what you're seeing is a lot of sellers still overpricing. A lot of realtors are not catching on to actually what's going on in the market either, and they're still pricing homes the way they would have like 3 or 4 years ago. And what's actually happening is homes are going on the market pretty high, but seeing reductions in prices as we adjust to this new kind of norm of home value. And then once you get into that base point of value, once you get the understanding about what the cost of a home is and the value of that home, then at that point, you see an increase in inflation month over month of about 2.4 to 2.8. But if you're listing something too high, don't think that you're increasing, over 2% on that price. It's the price that it sells for, right? That's the inflation point. So just keep that in mind as you go out there and price. Get really good at pricing. All right, it goes on. It says, climbing out of a gloomy winter, existing home sales reverse course following a sharp drop in January and ticked up slightly in February as housing affordability improved nationwide. The National Association of Realtors reported Tuesday. It says lower mortgage rates, rising wages, and slower price growth are offering improving conditions for prospective home buyers. First-time buyers also made a modest return to the market last month. Now, there is a lot inside of that one paragraph that we can dissect just a little bit to understand what's going on in our market. So let's just do a moment of pause here and think strategically about what all was said, because there is quite a lot on what's actually happening in our value of our homes and how we price, okay? So we saw a slight uptick. That's the first statement, a very slight uptick. Nothing crazy. Again, more of a stagnation, more of a rebalancing. But what it really says here is it says housing affordability improved nationwide. So why would you think affordability improved nationwide? See, now this is where the income, so if you curb the inflation closer to that 2% mark, then the average income increase of an American buyer is increasing a little bit more than that inflation. Now, keep in mind, this is a national perspective. It's all relative to local, because you might be in an area that has, people leaving the community because of jobs, or you might be in an area where people are coming to your area because of jobs, right? So there's some local, but when you look at it at a national level, the increase of income is outpacing the inflation that we see in the market. So that's that affordability gap. So when that starts closing that gap a little bit, interest rate comes down, makes the home more affordable, income comes up, inflation slows down. Okay, that is all what was said in this paragraph. You have the convergence where everything's kind of coming closer and closer together, which puts more buyers into the market, more people that might be in that middle road that have not been able to afford a home in the past couple years to be closer and closer as month goes by to be able to afford a house. So now keep in mind, it sounds like, whoa, we're going to have a big booming market. No, we're going to have a slow changing over market. Compare last year and the buyer traffic that we had last year to this year, you'll see an increase. The question though is now on the inventory side, you might have an increase of people wanting to buy, but where's that inventory going to land? So that's the point of tension, is the amount of homes coming on the market. Slight uptick, but nothing drastic. So even though you might have this affordability gap closing, you still have a gap in the amount of inventory. So both of all these metrics have got to converge into the center to create one surge of the way or the other. Right now, you have just slight micro changes on both sides, and that's bridging that gap a little bit. So you're going to see a more stable type of market that we saw last year, but very similar to what we saw last year. So just keep that in mind as we go through this. All right. Got a comment there. Yeah. Someone is, I'm going to mute that person. Chat can be fun. All right. Existing home sales, including single-family homes, townhomes, condos, and co-ops, increased 1.7% month over month in February. Still, sales remain down by 1.4% when compared to a year ago. So that's that percentage, right? It says, but the latest housing numbers do offer a hopeful sign heading into spring. Quote, and this is Dr. Lawrence Yoon, housing affordability is improving and consumers are responding. Okay, that's the thing. Is like we're seeing this improvement. It's a whole argument that I was just saying, and inside of that one paragraph was said a lot, right? Mortgage rates alone are making a meaningful difference. The drop from about 7% at the start of 2025 to around 6% today could put roughly $2,000 per year back into a buyer's pocket through their lower monthly payments. So we're looking at $2,000 a year. So, and this is the thing too, is like, just put that into perspective, right? You know, headlines always run so much about interest rates and how much this rate changes and people go crazy and they want to buy houses. Do you see what a 1 percentage point does? Like 1% reduction? On average, $2,000 a year. So significant, but nothing drastic, right? So these are marginal. Lower rates also are expanding the eligible pool of buyers. NAR data shows that the 1% decline in mortgage rates means an additional 5.5 million households can now qualify for a mortgage, including 1.6 million renters who could potentially become first-time buyers. There's a little bit of opportunity for you right there, right? If you have somebody that's renting and that kind of stuff and you want to get in front of them, there's 1.6 million on average that would be able to afford a house given this adjustment. It becomes basically where renting and owning become very similar in cost. So that's a factor. Prospective buyers may be gradually getting that message. First-time buyers comprised 34% of existing home sales in February, up from 31% a year ago. Again, this is what I'm saying, like, that is not a drastic increase. It is a change, and it's a positive increase, but it's nothing drastic. From 31 to 34, right? Positives and challenges remain for the housing market. It says, despite last month's increase, the housing market still has a long way in returning to pre-pandemic levels of transaction sales activity. Yoon notes, quote, there are more than 6 million more jobs than in 2019, yet home sales per year are down by 1 million, Yoon says, adding that housing demand remains muted relative to wage growth and job growth. Still, several factors are improving for home buyers. Wage growth is outpacing home price growth by nearly 4 percentage points. That's what we were talking about from a year ago. So the number of for sale signs is gradually increasing as well, with housing inventories up 2.4% from January, about 5% from a year ago. Still seeing a little bit more inventory, but again, not drastic. For now, home prices are moderating. The median existing home price was $398,000 in February, up just 0.3% from a year earlier. This is that cooling factor. This is why the interest rate did drop a whole percentage point. The median price for single-family homes rose just 0.2% a year over year to $401,800, while the median price for condos and co-ops increased by 0.9%. Then he breaks down it by states and that kind of stuff. Buyers may be in a better negotiating spot. He makes that argument here. These articles are linked in the YouTube description. You guys can go back and read these. I'm not going to labor this anymore, but there's a cool little graphic here that you can clip and post on social media, that kind of stuff. He breaks it down into regions, tells you what's going on there. Anyway, good article overall. We're just helping build a really good snapshot as far as like what the market is doing, and how that correlates. Now, what do we do with this information, right? When we start talking about existing home sales that have shown a month-over-month increase in several key regions, what does that mean? Slight price adjustments, all these type of metrics. What do we do with this information? How do we utilize this information for our clients and representing people better? And what can we do in response? Where's the opportunity inside of this? I would begin to create what it looks like and for a first-time buyer to enter into the market. In other words, someone that might be renting right now, the cost of rent versus the cost of ownership. That requires you to go into your MLS, pull what the average selling price is in your area, or go into your rental market, find out what the average rental rate is, and then use that dollar amount to use a mortgage calculator to figure out what pricing of home that person could afford, and draft up some kind of flyer, drip campaign, or something to get in front of the potential first-time buyers. Because they're already paying a lot. The interest rate dropped, they're saving a little bit more money. They could potentially be a new buyer, and we need to find that. I would then get very equipped at understanding home value. Take some classes, go research some data, find out what homes are selling for in your area, and learn how to price things correctly, because that's going to help you move more property. That's also going to help you get more referrals and get more inventory on the market and roll more property even for the seller. So that's what I would say is the opportunity here. There's not drastic opportunity, but there is some, and it's a little bit of an adjustment. So the agents that are adapting to this kind of stuff, this is the goal, right? All right, let's jump into our third article now. And this one again is by Florida Realtors. I keep coming back to them. So good job, Florida Association of Realtors. You guys are putting out some good stuff. But let me just say this. This is kind of one of those titles or articles and concepts I think we got to be careful with. And the title is this: should buyers tap retirement savings? It's a valid question, because I read an article, not this one, but I read another article talking about more and more people are tapping into the retirement and borrowing money against their 401ks, which means you have to pay that back. They're borrowing against their 401ks and using that for down payments to buy home to decrease the affordability gap. Here's the thing I'm going to just begin this whole article and this whole discussion from is I'm not a financial planner. I'm not a CPA. My advice is going to be based upon what this article is saying, and saying to you, my advice is take this information as realtors and encourage your buyer that's thinking about doing this to talk to professionals that know their finances in and out and can advise them correctly. CPA, financial planner. That's where you got to lean into. Now, that doesn't mean that we pay attention and we learn and we educate ourselves and we look at all the scenarios and we become familiar with the pros and cons of doing this type of thing. Because with the rising cost of the affordability gap and all these type of things, we understand that people want to own a home, and they're sitting on 401ks that have money in there, and even IRAs that they want to withdraw from that might be just sitting there for their retirement. So we have to kind of use this as an argument to say, well, maybe investing in a home, building equity in a house might make sense in certain scenarios for them to do so. Now, when you do that, you're taking a risk, because you're reducing the amount of money you'll have when you go to retire. So there's a little bit of a risk there. So let's go ahead and dive into this conversation, and we'll just kind of skim through this article just to kind of get an idea, because I think this is going to be a conversation as we get more and more into the affordability process of people trying to buy houses. So, sorry, I'm trying to drop something. All right, so let's go ahead and get into this. Like I said, the title here is by Florida Realtors. It says, should buyers tap retirement savings? And the subheading is, using retirement savings can help buyers cover a down payment, but experts say borrowers should consider the long-term financial trade-offs first. This is by Alex Vega. It says, rating retirement savings for a down payment on a home can be tempting, especially if you're struggle to scrape together enough money to buy. But should you? That's a very good question. Should they do this? Should you do this, or should your clients do this? Most 401k, and it says most, not all, And similar retirement savings plans like individual retirement accounts, IRAs, allow home buyers to withdraw or borrow, keyword being borrow, a limited portion of their nest egg for making a cash payment toward the final purchase price. But there can be hefty tax penalties and other short and long-term financial impacts to consider. Hey guys, thank you so much for the likes. I so appreciate that. It says, quote, planning is the name of the game here. Stephen Cates, a financial analyst at personal finance website Bankrate, said, and this is the quote, running the numbers, having a solid understanding of what you can financially cover and financially manage is going to be really important before you step into this. I can't emphasize this enough. You know, if you are deciding to tap into any kind of future retirement funds that you need to live off of when you go to retire or for health reasons or anything else, it comes with a considerable risk. At the same time, most 401ks require you to pay that 401k back. So you need to refund it. So that means you've got an additional payment that you've got to be making. So you have to weigh this. This is not a decision you just say, yeah, I got money there, I'm going to tap into this, and you just go. I would be very cautious doing so. I would talk to the appropriate professionals to give correct advice. If you have a client that is leaning this direction, we need to be careful to just want to sell a house. We should be their advocate. I think that's where we win. We build with relationships. We build through giving correct advice. We don't want to just make a sale just to make a sale. We want to actually help our clients. So if that's the case, we need to be very diligent in understanding this. And if we ask more questions against our clients, like if they come to us and they say, how, I'm borrowing from my 401k, do you think that's a good idea? What would be our advice? What would be our response? I know what mine would be. Mine would be like, well, okay, not a bad idea, but might be a risky idea. I don't know your finances. I don't know your particular situation, but I would advise you to go talk to your CPA, financial planner, and look at it from every single angle before you decide to do that, because it doesn't come without a lot of risk, right? That's what I would say. All right. Years of inflation, high mortgage rates, and skyrocketing home prices have made buying a home a major hurdle for many Americans. At the same time, the S&P 500 stock market index has had only 5 down years between 2005 and 2025. Okay, so this is the argument. They're watching their IRAs and 401ks, right? And they're seeing this has been kind of good, which has helped juice the value of retirement savings accounts. So looking at that and thinking, man, that's pretty stable. This over here is increasing fast. I don't have a home. So that's why they're going this route. At Fidelity Investments, the average 401k balance based on 24.8 million accounts was $146,000 as of December 31st, a whopping 66% gain over a 10-year period, according to the company. Still, many savers may have a ways to go before their accounts grow enough to fund a home down payment. The median U.S. down payment on a home in December stood at $64,000. That's nationally, right? Compare that to the median balance of 401k plans and IRAs, $34,400 and $10,476 respectively, Fidelity said. Median figures tend to skew lower than the average because workers who recently enrolled in a retirement savings plan haven't had time to build up a balance. So again, borrowing against that, probably not a good idea. It says balance between home ownership and saving for retirement. Last year, it took the typical U.S. household 7 years to save for a down payment on a home. Holy moly. It took them an average of 7 years to save for a down payment, down from a peak of 12 years in 2022. But still roughly double the time it took before the coronavirus pandemic, according to analysis by Realtor.com. So still, it takes a lot of time to save up that down payment. So this is why people are wanting to lean into this. This is what's driving in there. You're going to have clients doing this. Know your plan's rules and limits. It says most 401k plans allow participants to take out a loan toward the purchase of a primary residence, but there may be different requirements. For example, on how long the borrower has to pay it back. So this is those questions we can't answer as realtors. We don't know. This is where they need to go talk to a professional. There is a cost to pay back and a time that they got to do that for. The IRS also has rules that govern 401k plans. The agency limits loans to 50% of a borrower's vested account balance or $50,000, whichever is less. Savers with less than $10,000 in their plan can borrow the full amount if their plan sponsors allow it. So these are all factors, right? All right, it says other factors to consider, weigh the trade-offs before taking out a loan against your retirement savings. The funds you borrow need to be paid back, so you'll have to budget for that payment. The biggest risk with a 401k loan is what happens if you lose your job before paying it off. Okay, think about that. If you owe that 401k and you have to pay it back and you lose your job, how? How are you going to pay it back, right? How are you going to pay for the house? These are all factors. In such a scenario, the unpaid balance becomes a distribution that the borrower has to report as taxable income. It's also subject to an additional tax of 10% unless the borrower is at least 59 years and 6 months old. See how these are conversations that buyers should not just rush into. They need to understand the implications of making a decision like this on all fronts, from paying back to job to taxes. All these type of things are factored in. The hardship withdrawal option, the IRS permits 401k savers to make what's known as a hardship withdrawal to help them cover specific financial needs, such as medical or funeral expenses, tuition, and buying a principal residence. This isn't a loan, so you don't have to pay it back, but it comes at a cost to your retirement savings. And if you are more than 6 months away from turning 60, you will face a 10% tax penalty on the funds, which are also taxable as regular income. So again, a lot of options here, but a lot of risk. What about IRAs? It goes into that. IRAs operate differently than 401k plans. They don't allow loans, but do permit savers to withdraw up to $10,000 without a 10% tax penalty, even if they're younger than 59 and a half, as long as the funds are going toward buying a home and the saver is first-time home buyer. So there's a little bit of a caveat there, right? As with 401k withdrawals, one must weigh the benefit of accessing the funds against the impact it will have on much that they have on when they retire, what that looks like. Okay, so that's the reason why I'm even focusing on this, is because I had a long conversation about this. I had an agent that was representing a client, and they were asking me about this borrowing against their 401ks and that kind of stuff, and led me down this road, and it's becoming a big factor. There's a lot of this happening because of the affordability gap. It's expensive. You just heard the article. It takes up to 7 years to save for this down payment that people need on average to buy a house. That's a huge chunk of money. So people are not really the greatest at saving money. So if that's the case, then it could take them forever. So we got to factor all these type of things in. We advise our clients. We don't just try to make a sale. We help them along in the process. So that's what we need to do. So what I would do is if maybe you take some time to type up some pros and cons on what, the benefit would be of tapping a 401k or an IRA that you have just kind of ready for a client that maybe is wanting to go down that road. And at the end of that Q&A or that, FAQ type sheet, you have something in there that definitely encourages them to talk to a CPA and a financial advisor. I would point them in that direction very quickly. So I think that's really the only main action item I would extract from this. More so, what I would encourage you guys to do is just read up on the risks and pros and cons of 401ks and IRA, withdrawing out of that to use for down payments and things like that. I think it's just, doesn't mean we have to have all the answers, but I think we need to have some understanding about how this correlates to our clients and the risks that they're assuming by using their retirement funds to buy a house. And then knowing how to weigh those options. I think it's just good diligence on our part. Okay. Let's go on to our next article here. I'm actually probably not going to dive into this one today. I'm going to go into the last and final one. We're getting towards the end of the show here. Unless I can summarize this one. Yeah, I'm going to hold off. The one I'm going to hold off on until the next live stream is the internet says agents are doomed again. Here's what's actually happening. I'm going to hold off on that one. I think I'm going to dissect this one a little bit more. I'm going to end with, because I think I want to get to this article that I'm having here, because I'm going to kind of end here with this, because yesterday I talked about the private listing network, Compass and Redfin partnership, and what National Association of Realtors is doing in response to that and all that kind of stuff. I want to read an opinion piece in regards to the more or less kind of the anti-Compass argument of where they're saying that an agent owns the fiduciary responsibility to the seller, and how that's why they're for the private listing networks, to give that seller a soft chance to test the market. So this article here is an opinion piece. And I would call it an opposing view, and in some ways it is an opposing view. And I'm going to get into this. And to be honest, and just out the front here, there's actually a lot inside of this article that I would say I understand and I agree with the premise behind the opinion piece. But at the same time, I think the writer is missing a very key point in the argument against what Compass is trying to do. And I'm not saying I'm for the whole private listing network. Matter of fact, I find myself kind of right in the middle. I think there's an argument on both sides. I think having a private listing network where the seller wants to stay private for a period of time makes sense. There are certain scenarios where they do not want it syndicated out everywhere, and I don't think the seller should be penalized when they decide to go that route. I also think there is a benefit to doing that when you're trying to figure out pricing of a home. It makes sense to test out the market a little bit before the data gets recorded of the home. I think that is a fiduciary seller responsibility of ours. You know, especially when you have a changing market, you're trying to figure out price and value of a home. And I don't have much data to go on as far as the CMA is concerned. And I understand the argument is by having private listings, that data continues to get skewed, but I think I can make an argument against that as well, but that's a whole nother weed. But I think by me focusing strictly on what's best for my seller, which is who I owe fiduciary responsibility to. I don't owe it to portals. I don't owe it to the National Association of Realtors. I don't owe it to an MLS. I owe it to the seller. I have to do what's best. And I think there's an argument to be had that says I cannot quantify without any doubt in my mind the value of this home or what needs to be done with that home in every single situation. With that being said, I think there's an argument to be had that says I as a seller or me as an agent that represents my seller, there's a benefit for me marketing that home internally or in a private smaller network of agents to test out the price, the decor, the curb appeal, and maybe do some tweaks before we go live everywhere. Like a soft open, like other industries will do. Technology industries do beta testing for this very reason. Restaurants do soft opens for this very reason, right? This is the way the industry works across many different things. So apply that same logic. What's best for the seller? So that's where I lean. Now, I do think in almost every single case, it's better for the seller to market their home to as many people as possible. I think that's a good argument. I also think that and this is what this lady leans into in her opinion piece, is I do think, and this is where I would agree, is it also gives the best leverage for an agent that gets a listing to increase their lead pool. Okay, if you have a property and you market out everywhere, it increases the chances of you acquiring leads. So from a selfish, position for realtors, I think that's another benefit to it. Okay, so with all that being said, I wanted to set the stage a little bit to read through this opinion piece, and I'm get you guys kind of thinking. I don't want to lead you into the way you're thinking, and just understand that I'm like in the middle. I kind of understand all arguments, and I'm okay with letting this fight kind of happen above me, and then navigating that, and with what we're required to do. I'm good with that. I think we've been around this so many times. I think this kind of stuff is just fascinating and fun because it makes our industry just exciting. All right, so this article here is by Inman again. More specifically, it's an opinion piece, and it's by Bernice Ross. And if I probably will just do this, open link a new tab. I'll just quickly read just so we can get context here on who Bernice Ross is. She's a contributor of Inman. Bernice L. Ross, CEO of Brokerage Up Inc., realestatecoach.com. What a URL that is. That's crazy. That's a good one. Good job, Bernice. And Profit.Realestate is an international author, speaker, and trainer with over 40 years of real estate experience, 1,600 published articles, and 7 books to her credit. Inman News called Bernice America's top real estate coach. For over 3 decades, the industry's major brokerages and large realtor associations have hired Bernice to provide training content for their leadership, as well as their new and experienced agents. As a founder of Profit.Realestate and the Investor Scoop newsletter, Bernice is dedicated to educating realtors, consumers, and 1 to 4 unit investors about how to become debt-free and achieve financial independence through the real estate investing. That's the person that wrote the opinion piece, okay? So let's just kind of read through this. The title of this says, Ready to Kill Your Brand and Your Lead Gen? That's the question. Take private listings. So you see the lead in there a little bit in the context of what she's saying. More buyers likely means a higher price in a shorter amount of time. Now, on the surface, I don't disagree with that. I think that's a good argument. I think if you have more buyers coming into the property, the chances of getting a higher offer is increased because you could get a competing war and that kind of stuff, competition in the war and that kind of stuff, right? That's a good argument. So let's get into this article now. It says the Compass Zillow battle over private listings has raised serious concerns about consumer access to listings as well as the future of the MLS. Okay, so, and that's true. This whole topic has exposed a little bit of this underlying current of control, if you will, right? And even though Compass and Zillow have their altruistic opinions and what they think is best for everybody, pros and cons on both sides, there's arguments to have on both sides. I don't think anyone's thinking altruistically just about themselves and the consumer. I think there's something to gain on both sides as well. I'm not naive to that. I think that's absolutely what's going on. It's a power play. This is typical corporate fashion stuff. But when you have discourse like this and tension, it's good. It disrupts things that maybe might need to be disrupted. We don't do things just the way we've always done them just because we've always done them, right? We should always revisit. Now, she goes on. What no one seems to be discussing, however, is how private listings rob you of the opportunity to maximize your lead generation and build your individual brand. This is, okay. And she's not wrong, okay? Like, in this whole entire discussion, she's not wrong. We're not talking about the benefit of max exposure for realtors when you take a property and you market it massively everywhere. That's really not what we're talking about that much, right? We're really, Compass and Zillow both are talking about what's best for the seller. Her entire article, though, is going to make the argument on why it's beneficial for the realtor. And I will say, her points are correct. Every single point that she makes is 100% true as far as being beneficial. They are. It is on the surface, when you look at the marketability of a property that syndicates out everywhere, it opens up more opportunity for the agent to gain from that listing and leverage that listing for more business. Here's the caution, though, in this argument, is if we begin to do things that deter us from what's best for the clients we represent and deter us from the fiduciary responsibility we owe to the clients just for our own gain. And that trumps our decisions on how we approach our marketing of our abilities. We can distort the person that is most important about. And on my channel, in my position, okay, I'm going to lean very heavily towards what is best for that client that I have in front of me. I'm going to serve them the best that I can, fiduciarily, ethically, morally, and I'm going to focus there. I am a guy that focuses on long-term success, referral-based business, and I'm going to root everything I talk about here with that. And I'm not saying her points are wrong. We're going to get into her points. I'm not saying they're wrong. They're right. But I wouldn't make it the argument that this is the way you should approach this debate. I think it's a very slippery slope if we go down this road too much. It's okay to think about this. What I would say is, as we read through this, think about what she's talking about as a great marketing opportunity when you have a listing. All right, take it away from the argument about Compass and Zillow and all this kind of stuff, and just say, look, this is great advice for coaching on me to how to leverage the listings I have, regardless of what's best for the seller. But like every listing I have, take her advice and say, yeah, I should be doing this for all of my listings that I have. Okay, so that's where I would be. So anyway, this is where it is. All right. She goes on, when I wrote Waging War on Real Estate's Discounters 20 years ago, the key premise was maximum exposure equals maximum price. In my mind, that premise hasn't changed in 20 years. That works in a good market, Bernice. It works in a good market. But the problem is how do we know the price of the home? How do we quantify that what we're listing homes at is the correct price? When you have a shift going on, it becomes very difficult. And when a shift happens, a lot of times you list homes based on what the previous market had, and it's wrong. The buyer doesn't do that, which then leads to a bunch of reductions, which then leads to an assumption in the buyer about that home. and implants an idea in their mind. So yeah, a maximum exposure equals maximum price in a good market, and when you understand the value of a home. But when you have a shift, it becomes way more complicated. All right, number 1, she says private listings translate into fewer leads and less business. True. Least exposure means you get less leads. You as an agent will get less leads. It says while listings generate buyer leads, over half of those buyer leads also have a property to sell. This gives you the possibility to do 3 things, 3 sides: sale, listing, and buyer for the listing. If your buyer has a house to sell, that can translate into 4 sides and generate even more possible leads. Best of all, these leads cost you nothing. Again, I agree. I think this is the whole point. This is great coaching, but this is negating the argument about the seller, okay? I think, yes, this is good advice. This is, and every listen that you have, I think what she's doing is correct. I think she's right. You leverage your listing to gain more business. 100%. That's the product, right? You generate more business this way. In contrast, when your private listing sells through another agent in the private network, you only have 1 side. The best you could hope for is 2 sides, listing and selling to one of your own clients. In contrast, the public listings allow you to generate multiple buyers and seller prospects that your print and digital advertising generate. I agree. But again, fiduciary responsibility is to the seller. If we're making the argument about the Compass Zillow thing and the argument of Compass, you're actually making the argument for Compass. You're actually arguing that Compass has the seller in mind the most. And it's not that the realtor even loses, because again, like I would fall into the referral business. Like if I represent my client extremely well and I do what's best for them and I help them, strategically market the property and get the best price and not taint the historical data and that kind of stuff, then I'm doing the best for my seller, which generates more leads for me than an agent that's only looking out for themselves. Okay. Now I would, if I was to read this article and remove the whole Compass Redfin argument from it and just say, Bernice is telling you how to maximize marketing and leveraging listings to generate more business for yourself, I think this article is great. I think it's a great article. All right, number 2, lead sources you lose when you take a private listing. Public listings allow you to market and lead generate across a wide variety of both on and offline lit sources. On the other hand, private listings shut down your ability to lead generate from the following sources: sign calls, public open houses, signage on open houses day throughout the neighborhood. All right. Again, yes, public broker and open houses, social media and portal advertising, loss of face-to-face conversion opportunities. Yes, loss of video marketing opportunities. Yes, right? If I was to make the argument and say that this is how you would market a home and leverage this listing to generate more business from you, I think this is a great coaching advice. I would say doing all these type of things, tracking how many sign calls you've got off that sign, right? Knowing how that works, tweaking your sign to maybe generate more sales calls. There's some kind of creative marketing you can do to generate more sales off of your listings. This is great coaching advice. Public open houses. Is there ways you can tweak your open houses and make them better? See, this is great coaching advice. Signage on open house day throughout the neighborhood. In other words, do everybody in your neighborhood know that they're open houses? How effective are you at running open houses? These are all coaching points. These are all great coaching points. Public and broker open houses. Yep, this is another good one. Social media and portal advertising. Yep, you need to be doing all those things. Face-to-face conversion opportunities. Yep. Loss of video marketing opportunities. 100%, right? See, the argument is making it's confusing. All right. Number 3, problems marketing with your name. For decades, research has shown that consumers are much more likely to remember the company that has the listing rather than the agent. The primary reason is that most agents are still marketing with their names. The picture below illustrates exactly why this is the case. Yeah. I mean, I get what they're saying there. Sadly, most agents today are still marketing with their name as their brand. The Ebbinghaus curve of forgetting shows that people forget 70% of what they have learned in 24 hours. When potential sellers see your name rider on a listing, it's generally smaller than your yard sign with your broker's name. Well, that's also because regulation stuff also dictates that a lot of times. Also, since your broker probably has more than one listing in the area, they are seeing your broker's name in other locations. Hence, the importance of getting your individual brand out there in multiple places. Second, everyone has trouble remembering names, largely due to interference. We're bombarded with thousands of names daily on our phones, emails, text messages, and spam. The secret here is to brand using a function rather than your name. For example, AustinProbateSellers.com or HorseshoeBayGolfHomes.com. You don't have to stop using your name to brand. Instead, this is just great coaching advice, guys. Number 4, the big trade-off. Private listings are a huge win for your company's branding, not yours. The whole article is centralized on the concept that it's, sorry, I'm got to redo TikTok. There we go. It's centralized on you, focusing on you as the agent. This is not the argument that Zillow and Compass are having. This is not the argument that's at play here. What's at play is arguing what's best for the seller. And I will tell you this, and I again, leverage your listings. I think everything she's given is true. I think this is great advice, but leverage listings for more business, good advice, but we still owe fiduciary responsibility to the seller, what's best for them. And this national conversation we're having on this big global scale that Compass has exposed is a healthy thing to go through, right? So this is where I would just say, read this for great advice, but not really making a good argument for why we shouldn't do private listings. I think there's better arguments out there. Number 5, the biggest issue, what's best for your seller? Buyers want access to the listings in one place, whether it's on the MLS or on a portal. Granted, there are times when a private listing is necessary to protect the seller, especially with celebrities, high net worth individuals who fear being robbed of having family members kidnapped, as well as in divorce, stalking, or abuse. Okay, so she gives a little bit of a caveat here. The biggest issue, what's best for your seller? This is the entire argument, actually. And she's right, the biggest issue. The one she just laid out was all bent towards the realtor, not what the national conversation is talking about. So she's laid out all these things as the reason, as the argument for, but it's not the only reason. That's the subsurface one. This is the Zillow argument. This is the Zillow argument. At MN Connect, Next Home CEO, co-CEO James Dwiggins voiced his frustration when there were more private listings than there were listings on the MLS. As a well-qualified buyer, why should he be shut out from seeing these listings? Again, it's great for brokerage control, but is it in the best interest of your seller and potential buyers? The bottom line, whose brand do you really want to support? Yours or your brokerage who owns the private listing network? I know how I would vote. What's best for my seller always comes first. Okay, like, I don't know that I'm trying to wrestle here with her position. It's a little bit confusing. She gives an example on cases where it makes sense for sellers to go private listing, right? She sits here and says, you know, high net worth individuals, celebrity, those that have members that are kidnapped, family members that are kidnapped, divorce, stalking, abuse. These are all very valid reasons, right? So she makes that position. And she's right on every single one of those. That's true. She says nothing about how pricing is one of the biggest strategies. She's not addressing Compass's entire position. And that's their position. Their position is all above all those things. Okay, that's part of it. But it's also talking about how you represent the seller the best. And the argument is very simple. Is when you have a market that is shifting in price value and you throw a home on the market and that history travels with that listing forever, you've now put the seller at a disadvantage for negotiations. Or you could even stigmatize the property in the eyes of a buyer. That's Compass's argument. Now, there's arguments on both sides of this, but she's not arguing Compass's position yet. She's giving you great advice on how to leverage listings to generate more business. I validate every single point that she just made. But she's putting it into the position as an authoritative position, as an argument against what Compass is saying, as this is what's beneficial. Negating the seller and putting it into the mind of the realtor that this is what's best for you. This is what's best for you. And I just think that's a dangerous road to go down when you put it into that context. I really do. I think it's a dangerous one to go down. So, and maybe she has a different opinion about this. Maybe she's not thought through all the scenarios. But I mean, I just have, I'm not saying I disagree with the premise that Zillow's even proposed that the lack of data causes more harm than good. I'm not saying that. And I'm not saying Compass and what they're doing makes sense on all fronts. I'm not saying that either. I think there is a case by case basis. I think there is an argument to have on both sides. And I think if you want to use the word reform, needs to take place on all levels. I think it needs to be very considerate. I don't think we let Zillow or any other portal dictate to us what is best for our sellers. I think we look at that logically and we apply logic and reason and wisdom to that, and we adjust accordingly. I don't think, in matter of fact, the National Association of Realtors would probably agree with this because they made a statement, is they're not weighing in to this debate. They're saying that brokers and owners have the right to do what they want. Now, there's a little caveat there, and this is where I would lean into saying, and I would say this, is you as a realtor or as a brokerage that is a member of the association, the National Association of Realtors, and you syndicate your properties to the MLS and you put your properties on the MLS, you abide by the rules and regulations. You're choosing to do that. If you don't put it on there, then you're free. But if you put it on that MLS, you are required to do that. If you're a member of the National Association of Realtors, there are certain things you are required to do. I think you should do all those things correctly. It doesn't mean you don't have these conversations. And you look at it at all fronts. And if you're going to write an article and you're going to weigh into this argument, you address the points that the opposing party that you disagree with is bringing up. You debate them on their points. You don't twist it just a little bit and insert coaching into it and then insert your own opinion into it, even though it's an opinion piece. I get it. It's an opinion piece. But she has a lot of influence. I read her little biography there. She's been doing this for a very, very long time. And I'm not against her. Don't get me wrong. This is just civil discourse. This is good. But I think there's an element here where transparency needs to be given. I don't think she did a good job representing the opposing view. I just don't. I don't think she proposed it in its correct form. I don't think she's actually researched Compass's position on this, and even other brokerages that would argue for pocket listings. I think there's a whole nother argument to be had there that you got to get into the weeds a little bit more. It's not that simple. We're not talking about sellers that are celebrities and high net worth owners and that kind of stuff. That's not all that we're talking about here. There's many more things to the nuances inside of why Compass is doing what they're doing. And it sounds like I'm all for Compass and what they're doing. I'm just saying though, but like our mind has got to be focused on what's best for the seller. It just does. So anyway, that's the end of that. Yesterday I did a whole thing on the Compass side of it. We dissected on that. We've kind of saw the opposing opinion. If you guys know of an article out here that makes a kind of a better argument against Compass, I'm all for reading that. I've been doing a lot of reading on this. Share it with me, throw it in the comments, that kind of stuff. I would read that and dissect that. If you disagree with me, I'm all good with that too. I'm just really dissecting the information that is out there and listening to all sides of the arguments. And to be honest, right now, as I read these articles and I see what Compass is doing and their argument points, and I see what Zillow's points are, I have to say I lean more towards on the Compass side for the simple fact that their focus is on sellers and the fiduciary responsibility of real estate agents to their sellers. I'm not saying they got it figured out. I'm also not saying that it's not beneficial for them to do so, right? I know it is. That's the way these things always work. When these type of things come up, yeah, these people are doing this not because they care solely about sellers and my heart breaks for the sellers and that kind of stuff. No, they have a win here. This is what businesses do. But as a layperson reading information, trying to figure out how to navigate it and represent clients better, I think it's a good conversation to have. And I don't want to be dictated. I do not want my industry dictated by portals. I just don't. I don't think that they don't have my interest in mind. They don't have the seller's interest in mind either. They conflate things to benefit themselves as well, and they want data. So good argument, good discussion. I hope you got something out of this. I mean, we're just going to continue to dissect this, and I know it could be kind of confusing. But here, I'm just going to end with this though, is like the reality is this is where I would call there is a lot of noise. I think this is a ton of noise. We can get caught in this and all this kind of stuff and misrepresent our clients well. What I would encourage you guys to do is do business like you've always done business. Represent your clients well, be informed, know what's going on. Don't do any drastic decisions based on this kind of information. take advice, read through the lines of text of articles. Even her opinion piece has good advice, and glean that kind of information, then adapt to these type of changes. But get out there and just sell real estate. Represent your buyers and sellers. Don't get caught up in the noise. Just enjoy the conversations. Enjoy discourse. I think this is all good. I think this is what makes our industry so exciting. It's just constantly changing, and I enjoy it. Anyway, I went extremely over. Just a quick update. I will not have a live stream tomorrow. I've got to travel. So that means this is the last live stream for this week. I'll come back here Monday, 8:30 a.m. Eastern time, where you're watching me now. So I do appreciate you guys being here. Thank you all so much. I do value you guys, and I thank you that you take the time out of your schedule to come here and listen to me talk. I can't say thank you enough for doing so. So with all that being said, have an amazing day. That is your real estate brief for today. If you found this helpful, please consider hitting the like button to tell YouTube you would like more of this type of content, and consider subscribing and following to join a community of real estate agents that are focused on building a business that is relationship focused first. So with all that being said, I will see you next week, 8:30 a.m. Eastern time, right here where you're watching it now. Take care. Have a wonderful